The conversations are improving. So Pantera, actually, we're talking to several of the larger bank platforms to get our funds approved on them to be made available to their investors. And several of these conversations, they're telling us we would be the first digital asset fund on the platform. That's huge. That's like a massive unlock in terms of institutional exposure.
Perfect. Well, good afternoon, everyone. Thank you very much for everyone coming through. Looking forward to an interesting conversation around the digital asset space for everyone that's interested in that. I think to kick off, we'll just ask the panelists to introduce themselves. We can maybe start, Katrina, from your side.
Oh, I thought we were going to...
Ladies first.
Hi, everyone. I'm Katrina Paglia, the Chief Legal Officer and Chief Compliance Officer for Pantera Capital. We are a blockchain-only venture capital firm that invests in the early stage and seed series of various blockchain companies. We've been around since 2013, where we launched the first Bitcoin fund in the US. And happy to be here.
My name is Anatoly. I'm CEO and co-founder of Nickel Digital. We're a London-based multi-strat, multi-manager hedge fund. Been in business for 7 years. Prior to that, I was with Goldman and JP Morgan, and the whole idea of digital assets in a market-neutral kind of implementation emerged from the conversation with clients, and we thought that we're going to bring a solution which is non-directional in nature, on the understanding that not everyone from the institutional allocators would be able to underwrite directional exposure with vol of 70%, but something which is 1/10 vol of 7% may fit many portfolios. And that was our implementation, which we've brought to the market 7 years ago.
Hi everyone, it's Victor van Eijk. I'm with Maven 11. We're a Amsterdam-based crypto and blockchain investment firm. Core of the business is venture, same as Pantera. So we have 3 funds live since 2017. Over the years, we've branched out in some other areas, also in market neutral credit strategy that we run, and we're running some on-chain strategies. Total AUM of the firm is about 500 million. Team's based in Amsterdam, and we invest globally. Great to be here.
Perfect. And I'm Petri Basson. I'm the founder for Hash Directors. We're a fiduciary firm in the Cayman Islands providing directorships. I'm also chair for the Blockchain Association and used to be a director at KPMG Cayman, where I helped to set up their digital asset practice, and used to actually audit Pantera and Nickel. So it's full circle. I'm now sitting on a panel with them. I wanted to, Anatoly, actually kick off with you. I know in one of the recent surveys you guys did, you found that 2/3 of allocators now rank crypto as one of the top 5 asset classes they're looking at. With crypto now becoming part of portfolio construction, what are you seeing allocators actually looking at, and what are they considering as an asset class?
Yeah, I think it's important to differentiate that the same label of digital asset may hide very different return profiles. And we have to think about crypto as not a monolithic asset class, but rather having different streams. You have Bitcoin beta, you have altcoins complex, you have market neutral implementation, and then you have venture standalone. And each of them has very different return profile. So I think sophisticated investors, when they look at crypto, they should answer basic, straightforward questions. What is the Sharpe of a given exposure? What is the volatility? What is the drawdown profile of that exposure? In the context of profile, downside capture, duration of drawdown, if it is part of this allocation, correlation with other asset classes, specifically equities, as well as Bitcoin itself, and then whether the returns are repeatable or they're heavily dependent on the market regime. So all of this is critical consideration when you are constructing a portfolio. And the way you think about this is whether adding a crypto, because you have to realize majority of traditional investors don't have to be in crypto. And in our conversation, many of them pitch me why would I consider adding however small exposure of crypto to my portfolio. And it really comes down to diversification, whether it improves efficient frontier of a given portfolio, right? And whether there is a hidden beta which they may not be willing to underwrite if they go, for example, in market neutral implementation, right? So ultimately, they should not really kind of answer whether this only makes money per se, but really what sort of risks they're underwriting to gain this exposure, what volatility it brings to the portfolio. And on the implementation front, you have the whole spectrum of additional considerations. So one of them is whether they, put it this way, kind of access to this asset class, which used to be a bottleneck for many, many years, right? And Pantera was one of the first companies to bring a civilized, structured, and institutional access to this asset class. But now with the proliferation of ETFs, I think access pretty much is solved. It's not a bottleneck per se. It doesn't address the entire spectrum of implementations because, for example, for market neutral, you need an active management rather than passive. But all these things matter for institutional investors ultimately to make a decision whether they want to be in this asset class or not in the context of risks they have to underwrite. And on the risk side, you still have custody, you have counterparty risk, something which traditional investors do not think much in equity or fixed income world, but in crypto, it's still a large question mark. But yes, to your point, our survey indicated there is a structural interest to this place. But as an industry, we still have to address these concerns, which are in the air.
Okay. And just as a follow-up, when you're having these conversations, do you see them looking for a manager who can manage all these risks for them? Or are they considering investing in the asset themselves or just buying the ETF?
Well, actually, kind of traditional allocators from, put it this way, kind of the highest sophistication of an allocator, generally they would look for market neutral implementation. Mm-hmm. It's maybe unfair to say so, but kind of we are facing people like sovereign wealth funds.
Yes.
And their message, we are not in a beta business. We are in alpha extraction business, right? Because we have to protect capital first of all. And from that perspective, they would be looking for managers who can give them access to this market in institutionally safeguarded manner, right? Mm-hmm. So yes, they are actively selecting managers. Okay. As we are, because being a multi-manager, I'm in, my role here is actually kind of manager selection. I'm looking for systematic, market neutral crypto managers, which is kind of a challenge, right? Because you have to find these rare, brilliant managers who can control risk and yet extract alpha from the market. Mm. Of course, it's market evolution.
Which is not always that easy. Yeah. Victor, I wanted to take it over to you. I mean, Maven 11, you guys have worked on some very interesting products, bringing credit on-chain, working with tokenized securities. When you're out in the market, who do you see actually buying these kinds of products? Are the banks coming in? Is it sort of private wealth? Is it the traditional crypto crowd that is still looking at these assets?
Yeah, so we structured a pretty traditional finance vehicle, an asset-backed security with a large prime broker in this space called Falcon X, and we tokenized that and basically used DeFi rails as a capital formation and settlement layer, which is way more efficient for reasons that we can go into later, but it's way more efficient, cheaper, faster, composable, etc. So we built this like almost 2 years ago with a blueprint of an existing facility, let's call it on Wall Street, that exists to fund trading firms as well. So it's very legal heavy, and it's definitely something that a typical private credit investor would understand and appreciate. So we built it with in mind that somewhere down the road, a KKR, an Apollo, an RS, whatever, would be able to deploy into something like this. So we've now have it running for a year and a half. It's 150 million in size, which is in the bigger scheme of things tiny, but for crypto it's not a bad number. It's a seasoned product, so we bootstrapped this with crypto native institutional capital, also called like crypto funds, treasuries from crypto companies, high net worth people in this space, with the idea that at some point we would also be able to sell this to private credit investors. And we do have these conversations with these typical institutional funds, large and small. But the challenge still is that they appreciate the structure, they understand it, they recognize it, they see the guardrails, the legal robustness of the setup. But it's like, how do we incorporate this in our back office system, right? How do we interact with a DeFi vault, even if it's KYC'd and you know, it's something that would understand. So as much as I would like to answer yes to this product, we're not there yet on that front. And maybe to take it also from another side of our business, so we run some liquid strategies as well that we've structured in a regulated way in Europe. These are AIFMD compliant funds that we've been actively pushing to wealth managers and private banks in the space for years. And now finally we get like feedback from them in Europe, like, okay, we have an internal task force that is really tasked with how do we put this on the shelf of our private clients and how can we offer it to them? It's structured with, you can buy with an ISIN code, DVP, so they could incorporate it in the client portfolios, but only now we see like that they're working towards you know, allocating to these type of things end of the year. So it's been taking extremely long, but yeah, these parties move slow. So it's coming, but baby steps.
No, I recently had a conversation with someone and they said, we're just getting our risk department comfortable with tokenized treasuries. It's still a lot of work to get them comfortable with everything else, but it is in process.
Yeah.
And having fully regulated products, things that they understand, KYC'd, et cetera, that's,
Yeah, so we're working on it.
Definitely. Katrina, I wanted to take it over to you. You're at a very interesting spot where you're working on the legal regulatory side, but also at a fund. With Clarity, other acts coming into the space, where are you still seeing sort of the regulatory uncertainty being a blocker for allocators when they're looking at digital assets?
Yeah, I mean, just to take a step back, the progression I've seen over the years in my career at various funds, and prior to crypto, I was TradFi for about 15 years. And I remember the first time Bitcoin was raised as like this tiny thing we were going to put in this massive multi-billion-dollar fund, and the investors like freaked out, and it was just Bitcoin at the time. And it was like at like tiny percent. We want reporting on it. So that's how it used to be. We've come leaps and bounds since then, but we're not there yet. We had the Genius Act last year, which was the first stablecoin legislation and the first crypto legislation that the US passed. And that was a really big unlock and was something that got people really thinking like, okay, the US is actually supportive of this industry, this asset class now. And I think that's really been a huge pivot in terms of the conversations that we are having. Clarity Act, as you mentioned, this is the big unlock. And until we actually get this passed, I think the institutions are still going to sit on the sidelines for a little bit. And Clarity is not perfect, but it is something that's going to create the framework for, are you a commodity? Are you a security? Are you CFTC regulated? Are you SEC regulated? And we should all expect the SEC will still very much be involved in regulating these assets when they're at more of a nascent stage and relying on core groups of folks to deliver the profits. But there's an off-ramp concept in the Clarity Act, which is huge, and that gets you into CFTC land, and then you don't have this turf war that we've been seeing with the regulators fighting. I think allocators have been nervous. You know, you've seen the SEC go through a really aggressive phase where they were suing all the crypto companies. They were launching investigations. Crypto was #1 on the priority list for enforcement each year. And if you're an institution and you have very sophisticated investors and you're looking to underwrite an asset class, that's not super appealing to be walking into what is, you know, a very controversial space. That has pivoted in the last year or so. The new administration came in, seats changed over at the regulators. The regulators are reaching out to us. I'm having calls with them about custody. Custody is a big concern for institutions. They want to know who the qualified custodians are. There haven't traditionally been a ton of them, and that's partially because the custody rule is not really fit for purpose for digital assets. So we're having conversations about rulemaking, about exemptive relief, about ways we can purpose that rule in particular. That's one of the bigger issues, to allow institutions to be more comfortable that we will be able to comply with the qualified custodian rule and their assets will be safe. I think another controversial point is DeFi. I think there's a lot of nervousness and anxiety around KYC and AML in these decentralized exchanges. That's also one of the controversies in Clarity and one of the things that we have to figure out, and it's a really big source of tension. On the one hand, you have crypto, degens or the crypto native folks who are economic freedom for the world, KYC is relevant, you're kind of holding us back. And then you have, the large institutions that in the US in particular, like KYC is super important. So we do as an industry have to find a framework that works for everybody when it comes to the KYC component to DeFi. And that is something that's being worked through. But the fact that we're seeing Clarity push through the Senate with all the other things happening in the world, if you take a step back and think about it, it really shows how important it is to the government, to the administration, that crypto does get a clear framework in which to operate, which will then allow more of the capital to come in to the space. And then I guess the last point I will make, the conversations are improving. So Pantera, actually, we're talking to several of the platforms, the larger bank platforms, to get our funds approved on them to be allocated to their investors, to be made available to their investors. And several of these conversations, they're telling us we would be the first digital asset fund on the platform. That's huge. That's like a massive unlock in terms of institutional exposure. So, we're not there yet. Like, I don't want to be too Pollyanna on it, but I do feel like we're moving in a very, very quickly in a very positive direction.
Mm-hmm. To that point of AML KYC, what we're seeing, some of the allocators are pushing back on our potential involvement with DeFi. As much as we would like to be in this space, and certainly you can arb between, say, hyperliquid and other centralized exchanges. Yeah. But from the allocator's perspective, if you are underwriting DeFi risk and you are interacting with unknown market participants, that immediately kicks in AML KYC angle. And we were told, if you guys have even 5% exposure to DeFi, from our perspective as an allocator, the whole fund may be contaminated by kind of AML KYC angle. So I cannot wait to find a solution to engage properly. Yeah. How did you guys get comfortable with that?
The way that we think about it, there are these tools and products out there. Chainalysis is a really popular one that actually can track the wallets and can track the history. And it's called like node jumping or whatever. But you can kind of see where the wallets are coming from and if they've had exposure to like really bad stuff. Like you'll see terrorist financing was associated with this wallet. So we do a level of that when we do any of our DeFi staking. And we also limit the DeFi protocols that we are involved in. Some are a little bit more reputable than others. But we'll actually do a wallet analysis to see who's staking next to us in these DeFi protocols. And we'll pull out, I think we haven't had to yet, but we would definitely pull out if we were like too closely associated with something. So the information's out there, it's getting refined. The more people that are transacting, the more wallets, the more information you can actually kind of pull out of it and parse. So something does exist, it's not perfect.
Of course. But can you run this as a pre-trade check rather than post-factum?
No, you'd run it on a daily basis and you'd get a report of like the wallets that are trading in the pool with you. So you'd have to pull yourself out.
Yeah.
Well, maybe feeding off of that, I mean, Victor, Katrina, both of you guys are on the VC side as well. So are you seeing teams now building tools that are compliant as a baseline versus traditional DeFi? Is that sort of a trend or not yet?
Sorry, I missed the last part of the trading.
So are you seeing teams building specifically to be compliant, to sort of get that institutional capital to address exactly this risk?
I think about the portfolio. If we have the best example is Coinbase is in the portfolio. Coinbase does everything they possibly can to be compliant. The international folks, sometimes the conversations are, hey, I want to stay as far out of the US as possible. I don't want to have to deal with the KYC. I don't want to have to deal with the regulators. So then we talk about what it looks like to launch a token in Singapore and kind of what the concerns are there. And you can go in a variety of jurisdictions that have significantly more lenient KYC. But now that we are getting clarity with clarity, there's a lot of interest in coming to the US and being compliant because there's a ton of money here and these companies know this, these builders know it. So they're getting more comfortable with it. So yes, they're starting to think about it more, but that's because they know that they can actually do it in a way where they're not going to be targeted for enforcement.
Yeah, no, so we think as an intermediate solution to reaching that stage is how we set up this on-chain asset-backed security, right? So it's more of a CeDeFi, decentralized finance. So there is an entity, us in this case, like monitoring and curating basically this credit line. And it's a closed ecosystem, so we only whitelisted addresses can deposit data. They all went through AML and KYC. And that's, for now, probably the easiest segue for real institutional capital to get comfortable with DeFi products. And we only use DeFi for the efficiency and for the settlement, right? But to your point, like decentralized exchanges and real DeFi protocols is probably still a bridge too far for a lot of these institutional counterparties to really get active.
Yep. No.
It's interesting, the time frames, because if we cannot run KYC pre-trade, it might be problematic for the high-frequency traders like ourselves, because we normally turn our capital twice a day, right? So kind of it's measured in hundreds of millions of dollars, which are going through your trading operations. So ideally, I need to pre-check before but it may be kind of technically impossible, unless there are some other solutions which hopefully come into the market.
I mean, you could run a pre-trade, but you can't stop them from coming in is the point.
Right.
You know, because no one's KYCing it.
Yeah. Well, I mean, that's a good segue into the RWA and real-world asset space, because it feels like there's a very strong narrative about it. Everyone's talking about it, 24/7 trading in any asset with any potential asset being listed, but it feels like the narrative and the reality are very separate at the moment. You haven't seen very large adoption. You haven't seen that many people actually invest in the space. I'd like to actually put it open to everyone. For RWA to actually grow and really be adopted, what do you think are the main blockers at the moment and what needs to change?
I can start. So it again comes back to how do you incorporate this in your existing operation, right? I mean, for us in the crypto community, right, I think there's 30 billion of RWA assets on chain, which sounds like a lot of money, but it is fractional of if you compare it to, for example, the private credit market, which is somewhere between 1.5 and 2 trillion and expected to grow as well. And if you take all, assets globally, you're talking about hundreds of trillions of dollars, right? So it's a fraction that is available basically. So do you, as a larger financial institution, like overhaul your whole back office system now for a relatively small market? So to your question, like what could trigger this? I think if you look at New York Stock Exchange, right, working actively now on tokenizing equity trading and potentially others in bond trading in the future as well to be tokenized, that is something that you cannot ignore as a financial institution, right? And you're talking volumes of trillions a day. So that, if that comes to fruition, right, then you are forced as a financial institution to incorporate blockchain-based technologies into your back office system because you want to have like post-trade settlement, you want to have like custody, and then the marginal extra cost to add, for example, private credit opportunities is relatively low because the infrastructure is already there. So it's basically a combination of these factors coming together. But I think we also have to acknowledge that the market itself is still relatively small versus what's out there.
Mm-hmm. I realistically think that the biggest kind of use case of the whole blockchain technology is tokenization of assets, right? So this is the avenue which certainly will proliferate, and we're going to see migration of traditional assets on blockchain because, again, it's a much more efficient way to exchange value and transfer value. Having said that, there are two claims. One is this asset is tokenizable, and second, there is a secondary liquidity. This is a very different claims, and usually they are disconnected. Yeah. So you can see emerging tokenization projects, including, for example, in real estate, but there is nothing which supports secondary markets, which means it's really kind of doesn't deliver. From my perspective, what is required for the whole tokenization to take off is we need a kind of stronger link between redemption mechanism. If it's a digital twin of the underlying asset, what is the connection between tokenized assets and its underlying? Whether this bankruptcy enforceable, right? Second is whether there is actually liquidity and secondary market. And ultimately, what is the integration with traditional infrastructure, including recognized fund administration, recognized auditors, and transfer agents. Having said that, if you look on the most successful projects, you can see highly liquid assets already kind of being large part of a crypto ecosystem. First of all, it's a stable coin, right? This is the most successful project in the whole crypto environment. Second is oil. And what we see on hyperliquid, tokenized oil, which kind of coincidentally was launched in the beginning of January this year, just ahead of the military actions in Middle East. Suddenly there was a perfect market use case because ability to price oil over the weekend and offload risk over the weekend is something which is unavailable in traditional space, at least until recently, right? So from that perspective, you have CME oil futures, which run pretty much 6 days a week, but not over the weekend. Crypto closed this gap. Now, volumes are relatively small as it stands today. It trades roughly $400 million a day. At the peak, when March and February, it reached $1.7 billion or specifically over the weekend in 24 hours. How does this compare to traditional space? Naturally, oil on CME trades $120 billion a day. So it's like completely different dimensions. But let's not forget that when oil futures were launched on CME in April 1983, initially market did not take it seriously. Daily volumes were as minuscule as $4 to $5 million. So like only $90 million a month. Now in crypto space, we have oil, which is already trading at $400 million a day. So basically there is a very strong start. And I believe we're going to get this expansion, but we need to address the whole range of specific issues, which institutional investors will not underwrite and will not engage unless they're addressed.
Yeah, I would echo a lot of what you just said. I think the infrastructure for a lot of these RWAs is not the easiest thing in the world to do. Custody, you can't really custody a lot of these things that are now tokenized. And I think the biggest success, in addition to what we were just talking about, is the treasuries. So one of our portfolio companies, Ondo, I think was the first US Treasury to go on chain, and it's been massively successful. I do fully agree with the secondary market being very, very limited, and it's outside of like a treasury or a stable coin. What is the market for this fractional real estate ownership thing that kind of exists? I think it'll change. I think some of the stuff is exciting, and people like to feel like they own things. It's like the NFT craze. Like I own a piece of a NFT or whatever, and people really like it. The value is whatever you assign to it. So I think there'll be some interest in it, but I don't think there's a significant enough understanding and awareness of it outside of the crypto community. And I think a lot of what my fellow panelists have said about how we think it's a big number in our space when we hear certain things, but like we're still tiny compared to the capital markets. And I think our industry kind of should have a little bit more perspective occasionally on things and just kind of take a bigger look at how much resource we're actually putting behind some of this stuff. Because most people like my mother has no idea what I do. Like she's very good, she knows Coinbase, but like to talk to her about some of these companies, it's just, we need more education. The next generation's coming in, and I think that there will be more adoption of this just by nature of the kind of maturation of the individuals who can participate in the space.
Yeah, I think it's very, very good points in terms of the custody is not there. The secondary liquidity, just because you've tokenized it, doesn't mean there's a market and anyone's going to trade it. And then where that actual market is, because it's very fragmented at the moment. Yeah. So there's still quite a few things to fix. As we're wrapping up now, a lightning round for each of you guys. In one sentence, what would you say is the biggest unlock for institutions to actually start adopting digital assets in the next 12 months?
I think if we clarify the custody rule, that will be huge.
I think we have to make the whole crypto boring for institutional investors, so they can underwrite easily the whole infrastructure and focus on what matters, the market risk and various implementations and alpha which you can extract from that market. But make it boring.
Yeah, back to my earlier point. So the first pilots of tokenized equity trading, I think, is going to unlock a lot in the space and force people to really adopt and think about how do we incorporate this in our daily operations.
Brilliant. Well, thank you very much, everyone. Really appreciate everyone coming out, and thank you very much to our panelists.
Thank you.
Thank you. Thank you.